Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Continue the recent trend pushing lower. Nearing that midpoint of that 280 to 3% range, we traded as low as almost 293, sort of hitting that level we saw earlier late last week. And the market just seems very confusing. We issued $78 billion in paper between 3-10 and 30-year denominations, and the market just kind of took it in, no problem, and we continued to push yields lower. That was something I thought would have pushed yields higher, especially with the fact that these weren't strong auctions. We didn't see paper bidding over themselves to get a hold of it. They were what I'll call mediocre auctions at best. So right now, the 10-year and the Treasury complex in itself is sort of fighting the trend or going against the trend here as we see yields trickling down, supply issuance going up, and the rest of the world is kind of up in arms right now. If you look at what's happening in Europe and Turkey, you look at what's happening in Japan with the yen and the Japanese government bonds, there's a lot of reasons why things should be a little bit more tense, and they're not. And we're seeing yields kind of creep lower as opposed to that free fall drop. And if you look at market volatility, Treasury volatility, it's continuing back to that trend lower. We're nearing year-to-date lows. We're nearing the fact that when we see what's happening around the world, it's not really phasing the U.S. Equities are kind of trading sideways, nearing their all-time highs, and the dollar continues to trend higher, albeit at a slower pace this week. So right now, volatility not really in play, although if you want to look at it as kind of the greed factor is back in play, sure, maybe it is, but certainly we're not seeing any fear. And given that this trending lower of yields, given the trending lower of volatility, let's take a look at the Treasury yield curve, the 2s, 10s. Last week we saw it nearing just above 33 after trading down close to 23. And it looked like we were going to see a steepening trend reemerge, something we hadn't seen in years. And lo and behold, no, we didn't, because now we're back below 28. 2s, 10s is probably targeting 23, the decade low. And if the Fed comes in September, raises rates and talks about raising rates more aggressively, 2-year yields are going to push higher, while 10-year yields are going to remain stubbornly low. That will bring the inversion of the yield curve conversation back to the table, and that is something that the Fed will have to deal with, and will have to figure out a way to navigate. Because right now, an inverted yield curve means a lot of negative things for the economy. It means a lot of outlooks are not the same, and it means that things are just not lining up the way the Fed wants them to. Yes, the U.S. economy is strong. Yes, there is moderate inflation, but when you take the outlook of the market, you take the stocks on all-time highs, there's certainly a lot to risk here if we see 2s, 10s go inverted, certainly in the middle of a rate hike cycle. So right now, the 10-year yields continue to trend lower, albeit slower in yield. Volatility non-existent, and that yield curve back to a flattening trend. This is Todd Colvin coming to you from the floor of the CME Group.